Welcome back, traders. Ali Casey here from StrategyQuant channel. Today's video is more of the advanced robustness testing. So in the last couple of videos, I did Monte Carlo testing, simple and advanced. And if you didn't watch that, you can do so. I'll leave it in the description below or in the top corner on the left. If you watched it already, then this is the normal progression, which is System Parameter Permutation, SPP for short. So if you go to the cross checks, which is our robustness test, you'll find that this is the system parameter permutation. Now, before we jump into this, you need to know something, that although many people talk about biases and optimization and curve fitting, let's make one thing clear. Anything you pick, that's an optimization. So we can start by, let's say I want to do a strategy on the S&P 500. Already I am biased towards the S&P 500. Already I picked something. Even if you pick a portfolio, you're already biased because you're going to pick a portfolio out of 250 assets and, you'll pick 10 of them. And that's already, again, that's bias. And if you're into stocks, same thing. When you pick a basket of stocks, that's a bias out of the, let's say, 9,000 stocks available in the United States. And then you pick a time frame. Let's say you say, well, I'm going to do my strategy on daily time frame. That's also bias. So not all bias is bad. Then that's what you should do. So bias is good to a point. Now, curve fitting, on the other hand, not good. So we distinguish between those two, and then we can understand how these things work. So last time, like I mentioned, we did both Monte Carlo. And if you remember last time, I told you that these two, the first one and the last one, which is randomizing strategy parameters and history data, this will accomplish a lot. And then the next logical step is to do it with this system parameter permutation. Now, this system parameter permutation is invented by a gentleman named Dave Walton, and he actually won a prize for it because it's really a good way to vet strategies. That doesn't mean it's perfect. You need to understand how to use it. It's like any other tool. If you use it correctly, then it's really helpful. And if you don't use it correctly, then it's not as helpful. The implementation of SPP in SQX is really good. First of all, it's part of this, which you can automate. So that's excellent. And the next part, there's nothing to optimize actually, because SQX will pick the most logical periods to optimize. So like we saw in the Monte Carlo, where we can change the parameters and we can change the price, this one is fixed. It will pick the most logical, basically entry, exit, multiplier of profit loss, profit target and stop loss, and indicator periods. So let's say RSI 10, RSI 50, and so on and so forth. Because, of course, each block in SQX can be optimized. And if you're going to do that, then this calculation needs a supercomputer to finish because it's going to be in billions. So SQX has to make some decision somewhere to make the calculations easy to manage. And you can only do the maximum number of tests. And in some version you can pick and choose what to optimize. But I love this idea where you don't do as much. But you can, of course, filter. So in order to achieve this, I built some strategies here. So nothing out of the ordinary. Yes, I picked me reversion. I picked some strategies. Then I took them to the retester. Here they are, 901 strategies. So here is the filter for the optimization. Once SQX takes all these strategies and then re-optimize all periods. And the recommended filters is this, is the percent of profitable optimizations more than 30%. And the average profit in dollars of all optimization is above zero. Uniform distribution of the results, and I'll show you what that means. And best optimization profit is less than one standard deviation of the average profit. And I'll show you also what that means. And then here we have net profit median is greater than 0. So if you go with the default, of course, you can do your own settings. But even if you go with the defaults, then you'll filter it. And this is what I did once you have everything in the retester. So if you don't know, you just pick this and you say retest and copy. So you keep the original here. It will copy everything to the retester with the strategy logic. So data and trading options and everything. And then when you come here and you pick the default and then this filters. So now I'm left with 350 strategies out of the 901. So almost a third of the strategies pass the filter. And then each of those strategies, you will have a optimization profile and a system parameter permutation profile. Now you'll see a message here that says the chart, the 3D chart, which is a representation of all the data, it's by default it's off because it consumes too much memory. So if you're doing this on automation, like me, what I did here, building thousands and then vetting them, then no need for this 3D. But if you're doing 1 or 10, then you can still do save the 3D chart and you can see it. But basically, this is what it tells us. This is the average net profit, and this is the distribution. I don't know if you can see the color is not as contrasty, but basically this is the average, which is good. And then the system parameter permutation is where all the data is shown. So to understand this, let's focus on, first of all, net profit. This is the net frequency profit. And you can see that the median value is this red line, which is 90,000 something. And our original curve is the green line. That means our strategy is actually on the upper side of the expectation. So what you want to see is your green bar is below the red bar in net profit. Think of it this way. If the strategy originally made $20,000 and the median is $21,000, obviously that's really good because your strategy is below the median. That means you expect the future to be better, or at least the median. So then the future is better than what you tested. In this case, our strategy is already making 109,000 and the median is 92,000. So we're already above the median of the future, the expectation. The drawdown frequency, the median is 10,000. Our strategy has a lower drawdown. Again, that's not what you want to see. You want to see your strategy having a bigger drawdown where the median is less. So it's opposite of net profit. And same thing with the maximum drawdown frequency. You want your strategy to be above the red line so that the future will be better. And then return to drawdown ratio, we go back to net profit, Sharpe ratio like net profit, and the compound annual growth rate also like the profit. So these two, you want the green line above the red line because they are drawdowns. And these four, you want the green line below the red line because they are based on net profit. Of course, if the difference is not noticeable, let's say this is 90 and the green line is 91, that's totally okay. It's just you don't want to be too far away from the median. And that's a judgment call on how far you want to be from the median. So then this will give you, of course, each strategy has its own distribution. So for example, this one is good. This one is exactly what I wanted. So net profit is below, return to drawdown ratio below, the Sharpe ratio is below. So that means in the future, I expect my strategy to perform better than what this performed. So this is 34,000 with a drawdown of 12. I expect my strategy in the future to do better net profit and less drawdown because that's what the distribution telling me where I am currently regarding the median. So this is really good. So you can see some of them will do good, some of them not as good, and some of them really not that far away. So for example, this is too far. The median is 27,000 and the strategy is 37,000. So that's a huge margin. And again, like I said, it's a judgment call, but you need to find what's the proper distance and then you stick with it. And then sometimes you see it like this. It's too close. So I assume this is good. I am near the median. So all in all, the SPP is the culmination of these two Monte Carlo strategies. The problem is it's slow. So if you're automating, just remember that it is slow. Now, it's not that slow. I mean, I did the 1000 test and the 350 test, and I watched like a YouTube video. So probably it took, I don't know, 5-6 minutes. So it's not that big a deal, especially when you want to automate stuff in custom projects. Then that will play a big role because then you can automate everything and find out the best strategy. So this, like if you saw my video, I said I don't consider Monte Carlo as a robustness test and I use it for capitalization. But this is definitely a robustness test and you should use it, or at least you should read about it. Now, this is the paper of Dave Walton that he won the prize of $10,000 with. And you can read it and see how he did it. It's a free, you can download it here. I'll put the link in the description below. And if you decide to use it, which I highly recommend, then it's built in SQX. And SQX actually the only package, retail package that I know that has this built-in calculation and also built in into the automation part, which is a huge advantage in when it comes to automating vetting strategies through robustness testing. So as usual, I hope this was useful to you. If it is, please like, subscribe, share, as Google will likely push the video to other traders when you do that, and it also helps the channel grow. And until the next video, good luck with your trading, stay safe, and I'll see you soon.